My name is Joe Nagy, and welcome on behalf of the committee. Welcome to the discussion on the global financial crisis 2.0. In case you're wondering, is it coming, and what can Australia do this time around? Before I begin with introducing the speakers, I'll just acknowledge the traditional owners of this land on which we are gathered, the Gadigal people of the Eora Nation. Our first speaker is Dr. Stanford. He's the economist from Australia's Institute Centre for Future Work. He recently came to Australia after working in 1974 for the Toronto-based Unifor and its predecessor union, the Canadian Auto Workers. All that's very good, but the best thing he's got going for him is he comes from my hometown university, McMaster University. So we have to give him a good hand when he gets a moment. Our second speaker is Ashley Lavelle. His teaching focuses on Australian politics and Islam and the West. His most recent book is The Radical Challenges to the Family, from the 60s to same-sex marriage. Dr. Stanford will start.
All right. Well, thank you, Joe, for that warm welcome with a Canadian twinge to it. Go Tiger Cats! Tiger Cats is the gridiron team that Joe worships back in Canada. Whereas here, of course, we've all learned the Aussie versions of it.
Manly.
Right. Okay. As Joe says, I've just resettled in Sydney from Canada, as your former Prime Minister, Mr. Abbott, called it. Canada. I think he said that just before he ate the onion. We couldn't believe that picture up in Canada. I was still in Canada when that happened. Is that an Aussie thing, just biting into a raw onion? No. That's a Tony Abbott thing. Okay, good. And this is the last time I spoke at Politics in the Pub. Actually, I still lived in Canada, so I lived around the world. Now I live just down the street, just down on Bridge Road here in Camberdown. So this is fabulous for me. It makes it very easy to stagger home after the meeting, the Q&A, and the drinks afterwards. So I'm very glad to be here and hear about all the struggles, progressive struggles going on in Australia. Let me start by saying just a little bit about the place I'm now working in Sydney. It's called the Centre for Future Work, and it's a new project under the umbrella of the Australia Institute, which, as you know, is, I would say, Australia's leading progressive think tank. They're certainly very effective at getting the word out into the media and public debate and everything like that. And so they're starting this project called the Centre for Future Work to build their own focus in the areas of work, employment, labor relations, fairness in the workplace, industrial relations, industry policy, economic development, and those sorts of issues. So I am so far the director and only staff member of the Centre for Future Work, which means I get to boss myself around all day. Anyways, I think it's a great organization. I'm very, very glad to be part of it. And we have a website. The website is futurework, all one word, .org.au. And I'd encourage you to take a look at it. We've already got a couple of studies up there. We released a major study last week, the week before last, about the future of manufacturing in Australia, debunking the myths that manufacturing is an old, dying industry, that it's inevitable that it's going to leave, showing, in fact, that Australia's deindustrialization is completely unique and extreme by the standards of other industrialized countries, even other high-wage industrialized countries. In fact, Australia now has the smallest proportion of work in manufacturing out of the total workforce of any OECD country. Lower, believe it or not, than Luxembourg. Okay, Luxembourg, which of course is the world's largest gated community, and I thought they were all bankers in Luxembourg, but apparently there's still a few factories as well, and they hire more people proportionately than in Australia. So check that out. We've also got an infographic and an analysis as documenting the expansion of precarious or insecure work in Australia, including the incidence of part-time, casual agency jobs, and so on. And then next week, I believe, we'll have a report coming out that provides economic evaluation of the coalition government during its current period in time, to debunk this claim that they are naturally the best economic managers, right? We've heard that claim a gazillion times, and we're going to hear it a gazillion times more before July 2nd. But if you actually look at hard economic numbers about people's jobs, who's working, what they're producing, what incomes they're generating from their jobs, and whether they can pay their bills at the end of the month without going into unsustainable debt, that's the economics that everyday people experience. By those metrics, in fact, the economy's done much worse under the coalition and not better. So please check those out, and I look forward to staying in touch. Now to the subject of the day, the next financial crisis. As Joe reminded you, the evening is organized around two questions. Number one, will it happen? And number two, what can Australia do about it? Well, the answer to the first question is very easy. Yes. Yes, Joe, it will happen. In fact, in Canada, we have a colloquial way of answering a question that is obviously yes. Okay, and I'll induct you into that colloquialism. It is, does a bear shit in the woods? Okay? Does a bear shit in the woods? So that is my Canadian answer to the question, will the next financial crisis occur? Does a bear shit in the woods? There's other versions. I'm sure we could come up with an Australian version involving redback spiders and saltwater crocodiles and other creatures. Because that question was so easy, I will add two sub-questions to our mandate as speakers. Number 1A, precisely when and where will it occur? And number 1B, how and why will it occur? As far as 1A goes, when and where, I don't know. If I knew, I would short the markets, make $1 billion, and fund politics in the pub and every other progressive cause in the world forever. Unfortunately, I can't predict exactly when and where. I can talk a little bit more, though, about why and how the next financial crisis will occur, and why I am as certain as I am of anything in life that, in fact, there will be another moment of crisis for this financial system that we live under. And it does allow what we're really here for tonight, which is a broader discussion about the workings of the credit money system under capitalism, which is something that really, as social change activists, we should all know a little bit about. The short story of the phenomena is that our banking and credit and money system is dominated by privately owned banks, which, like other private companies, are institutions organized and operated with one goal and one goal alone in mind. To ruthlessly maximize the profits generated by the enterprise and maximize the wealth of the shareholders who own the enterprise. The thing that's unique about private banks that makes them different from any run-of-the-mill exploiting organization in our economy is they literally have the legal power to create money and lend it out of thin air. Literally have the power to create money and lend it out of thin air. Now, when I say something or somebody else says it, you're tempted to say that person is a paranoid lunatic, saying something as extreme as saying banks have the power to create money out of thin air. Well, I've learned over many years of experience that just because you're paranoid, it doesn't mean they're not following you. Okay, so just think that through. And the fact is that it's true. And in fact, interestingly enough, in the years since the last financial crisis, the GFC of 2008, 2009, I'm always interested that with that acronym, the GFC, Global Financial Crisis, it was invented in Australia. And Australia was the only OECD country that didn't have a recession because of the crisis. So it does seem to me, coming from a country that did have a wicked recession because of the crisis, that you got to name the crisis when you didn't even have the recession because of it. So I'm reclaiming the acronym for that last crisis. Instead of the Australian GFC, we've got some Canadian editions of it. I had thought of MOAM, M-O-A-M, Mother of All Meltdowns. So that could be what it was. Or I'd also thought of BFEC. The first one is big. The rest of it I'm not allowed to say while the camera is running. So you can think about that afterwards. Whatever it's called, in the years since that financial crisis, there's actually been a little bit of introspection, not enough, but a little bit of introspection and honesty on the part of conventional or mainstream financial economists. And there is a growing recognition that the traditional way that the banking system was understood was wrong, the traditional textbook model that was taught to economics students in university was wrong, and that in fact the banking system operates in a different and perhaps surprising way. For example, the radical organization known as the Bank of England, published in its 2014 quarterly bulletin an article on how does the banking system actually work, which you'd think is surprising that a central bank, to the people who read that sort of thing, right? I mean, we're talking about stockbrokers and bankers and other members of this community. It's funny that they need to hear from the Bank of England about how the monetary system actually works, but they published this article. And they were frank about it. They said, whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. And this was as explicit of an admission from a very respectable, mainstream, powerful organization as England's or the UK's central bank, that in fact this is how the banking system, the private banking system works. Every time they issue a new loan to a customer, they literally are creating purchasing power in the form of money. Now, not money in the traditional sense of having banknotes in your wallet, it's still only the mint with the authority of a state behind it that can create and print actual currency. But money, of course, is not currency in today's world. Most money is an electronic entry in a bank account or a checking account or a line of credit account or some other form that allows the use of this as money with all of the traditional characteristics of money: the purchasing power, the measure of value, and the store of value. So it's interesting that the crisis did spark a little bit of honesty in fact that the banking system does work that way. I prefer the way that John Kenneth Galbraith described the process. John Kenneth Galbraith was born in Canada, by the way. I'm really on a patriotic tinge tonight. What's that?
He attended the University of Western Ontario.
Yes, he was born in Canada, attended university in Ontario, but then, like so many Canadians, including Shania Twain, only became famous when he moved to the United States. So, John Kenneth Galbraith said, "The process by which banks create money is so simple that the mind is repelled." That was Galbraith's vision, and in fact it's true. As I say, if you just say banks create money out of thin air, but in fact that's how it works. Credit, the creation of new credit through a loan to somebody or some organization, is the main source of new money. Credit is accountable for, or accounts for the growth in money supply and hence in purchasing power in the economy. And this very important function of creating new credit, which allows for the purchasing power that's required to purchase the goods and services that we produce in our economy, has been outsourced. I think of credit as, in a way, a utility. Just like the electricity running through the wires, you have to have electricity running through the wires before you can turn on a light and do anything else in the economy. And the same is true in terms of the distribution of purchasing power through the economy that allows people to buy goods and services that are produced, whether they're buying private goods and services through purchases from a private firm, or whether they're paying for publicly produced goods and services through the taxes which they pay to government in order to take advantage of those services. There's a popular myth, and this is the traditional conception of banking in the old textbooks, that the bank is simply a middleman, if you like. In fact, they're often called financial intermediaries. And the idea is that some people went to the bank and deposited their money in the bank and earned interest, and then the bank lent that money out to others who took the money and did something useful with it and paid interest to the bank, and the profits of the bank are the difference between what they pay us as a depositor, which is almost nothing, as you know, and what they charge people who came and borrow the funds. And this is related to the whole myth that this process of financial intermediation is actually a fundamentally productive function. What we're doing is capturing the savings of hardworking Australians and thrifty housekeepers who put their spare coins in the jar and then take it down to the bank to deposit every now and then the bank productively reallocates those real savings in order to finance things like investment by growing companies who are expanding their operations, hiring new workers, developing new technologies, and so on. This vision of how the banking system works, collecting the savings from people and allocating them to productive investments, was depicted for me most memorably in the classic Walt Disney film, Mary Poppins. Okay, hands up who's everyone, hopefully everyone in the room has seen Mary Poppins. Okay, and we all know what happens in Mary Poppins. The father of Jane and Michael Banks works for a bank. Okay, and he's trying to convince his son, Michael, to take tuppence that he's saved and deposit it in the bank. Why? Well, because he can earn interest on it, and that way the money is working for little young Michael. And they go to the bank, and Michael actually wants to use the tuppence to buy food to feed the pigeons, right? He's seen the pigeons and the poor woman who feeds the pigeons in the square. So he's reluctant to put his money in the bank, and then the bank's directors, led by the owner who can't quite stand up, sing him a song about why he should deposit the tuppence in the bank, because you'll be part of fleets of ocean greyhounds, plantations of ripening tea, dams across the Nile, and all kinds of other real productive ventures that are financed because Michael and millions of people like Michael took his savings and put them in the bank. Of course, Michael eventually refuses to put his money in the bank, and other customers hear him screaming at the bank owner, "Give me my money back." They get worried, they all demand their money, and the bank collapses. So there's a tiny element of truth in that story, which is that banks are fundamentally fragile institutions that depend completely on the subjective confidence of people in the existence of the bank. But other than that, it's part of this fairy tale that banks are fundamentally productive financial intermediaries that collect savings and invest them in productive ventures. Its depiction of a bank collapse isn't even correct, because it's not the failure of confidence on the part of depositors that causes banks to collapse today. It's the failure of confidence on the part of other banks that causes a bank to collapse in the modern system. So a bank can literally create spending power out of thin air just by issuing a loan to a new customer. If they are convinced that the customer has a good plan and is creditworthy and is likely to pay back that loan, then they will. They don't need the cold hard cash to have already been deposited in their coffers by customers who come. If they don't have enough cold hard cash at the end of the day to actually give currency to people who are withdrawing it from the bank, then they turn to what's called the interbank lending system, which is this very complicated financial system that operates overnight, where the banks all lend each other whatever money is required to balance off their payments for the day and allow the system to work. And they pay a tiny little interest rate on those overnight loans. So it is possible for a bank with no depositors at all to set up shop and operate as a credit-creating institution. What they have to do then is borrow money all the time from other banks, or what's called the commercial paper market, in order to fund their currency payments out to those who like it. So that is the reality of modern banking. And the problem is that it, even more so than in the Mary Poppins depiction, is a fundamentally very fragile and unpredictable and unstable system. Sometimes bankers are willing to lend money to anyone with a pulse, okay? They constantly face a fight of two conflicting emotions. You know, they've kind of got the black devil and the white angel on their two shoulders. And those two emotions are greed and fear, okay? When their greed overwhelms their fear, they will lend like there's no tomorrow, okay? Because they're not worried about repayment. They're only got their eye on the profit that they're going to make from the interest payments that are forthcoming. So they'll do things like send out letters to people they've never met saying, you have been pre-authorized to take this credit card and spend up to $5,000 on it. You know, and they don't know you from a hole in the ground, but at that moment, they're more interested in the profits from new business than in the risk that you'll take the money and fly off to Fiji and never come back. At other times, though, when their fear overwhelms their greed, they will not lend to the most reliable ventures, including some of their own long-standing customers. So you often have a situation in times of crisis or fear where small businesses and others who've dealt successfully with a bank for years can't even get their existing loans rolled over because the banks are calling in the loans in order to reinforce their own financial coffers, to, in essence, putting up sandbags around the flood, just like they were doing here in the northern beaches the other day, to protect themselves against the risk that a crisis in confidence would cure them. So that conflicting battle of emotions creates a natural cycle in banking. It's actually called the banker's cycle, where when greed is overwhelming fear, credit expands quickly, lots of purchasing power is flowing into the economy, and you tend to see some benefits from it. They may not be the wisest benefits, the most sustainable benefits, but when credit is growing rapidly, you see a lot of spending. I'll tell you that much, sometimes on not the most useful things. It could go into the ridiculous inflation of housing prices, as we're seeing in Sydney and other major cities in Australia. If people had to pay real money, there was no way that they could pay that much for real estate. No way that they could pay that much for real estate. What is happening is you're getting a self-reinforcing situation where easy access to cheap credit is allowing people to borrow, fund, buy, and bid up the price of real estate, which in turn enhances the demand for still more lubrication in the form of cheap credit. It could also be used to speculate on financial investments of a speculative nature. Rather than financing real business, credit can be created in order to fund investments in purely paper undertakings, such as credit-related derivatives and so on. And we saw that happening in the American financial system in the years leading up to the meltdown. Hyman Minsky was the U.S. economist in the sort of post-Keynesian or structuralist tradition who really analyzed the problem of fragility and the internal reinforcement of fragility. It didn't just happen once because of a random event or a shock or something that scared the system. He showed that these repetitive crises of confidence in the system were in fact internally regenerated by the way that by the system's operation, including the profit motive of the bankers, their ability to leverage credit to create new loans with very little, if any, initial startup capital, and even the psychology of memory, if you like. Minsky explained how in periods of stability, people become overly confident in the investments that they've made, and that stability itself reinforces their willingness to go even further into debt, to further leverage their investments and create an underlying instability. And he identified the different stages of psychology, going from hedge finance to speculative finance and ultimately to Ponzi finance, where people had to borrow just in order to pay the interest on the loans that they'd already taken out, let alone repay the loans, let alone repay any of the interest on it. At times of heightened leverage, you'll see ratios in the order of about 50 to 1. That is to say, banks are lending out $50 worth of loans, which appear as assets on their balance sheet, for every dollar of their own money, their own capital that they have invested in the operation, 50 to 1. And then they can even, people will, the borrowers who are then betting on financial markets can leverage their own borrowing by significant amounts as well. So you can imagine if there's $50 in lending for every dollar in actual capital that the bank owns, this is a fundamentally fragile undertaking. All you need is a moderate loss, a loss of 2 or 3% on the assets that have been financed this way in order to completely wipe out the capital of the bank and obviously spark fears that it's going to collapse. Now, the response to this crisis in the GFC, I'll go back to the Australian acronym, by international banking regulators has been to moderately enhance the regulatory limits on how much banks can leverage their initial capital. And there's a whole set of rules by an international group called the Bank for International Settlements and its Basel Committee, which have been imposed on banks around the world, including in Australia, that requires them to maintain a little bit more of quote-unquote high-quality capital in their own coffers in order to finance these leveraged creation of loans, which is their main business. And some countries have actually gone further than the Basel rules and strengthened their own regulations on banks. But again, they're all matters of degree. For example, the Canadian banking system has been subject to a global leverage ceiling, which means any of the banks in Canada must stay within a leverage ratio of 20 to 1 instead of 50 to 1. So that's one of the reasons they say that Canadian banks were relatively stable during the downturn. They were also relatively stable because, like Australia's banks, they're concentrated in very powerful, profitable organizations in a small market. And that concentration gave them very strong financial situations that they were able to withstand the worst of the storm. Another reason the banks both in Canada and Australia survived was because the government rode to the rescue at the time of crisis with hundreds of billions of dollars, literally hundreds of billions of dollars of financial guarantees, which were eventually paid back once the banks restabilized. But at that moment in time, they were essential to the bank's future. So in my judgment, those improvements or adjustments to regulation of the banking system are really a matter of a degree. The system is still fully dependent on the confidence of others dealing with the bank that the bank will still be in business tomorrow. Therefore, I will lend the bank some money in order to cover its cash transactions through this interbank overnight lending system. And without that confidence, even a 20 to 1 leveraged bank will collapse in a day, just like a 50 to 1 leveraged bank can. And the combination of the short memories of financial investors, the process of competition in the financial system, whereby bankers and investment brokers are forced to try and keep up with the most profitable, most innovative, most adventurous investors, combined with the leverage process that I've explained, means banks will always go through these cycles of exuberant expansion, followed by fear, crisis, contraction, and ultimately, for some of them, destruction. Now, Australia survived the last banking crisis in relatively good shape. That's partly because of the structure of the banking system. It's very small and concentrated. As I mentioned, you have 4 big banks that can dominate the market. In Canada, we have 5 big banks that dominate the market. The government support that was offered to the banking system, but also the government bailout, or the government macroeconomic stimulus that was implemented under the Rudd government, which, to its credit, is recognized as one of the most effective responses to the global recession of any country, and does explain why Australia did not experience an outright recession. That is not going to happen next time. And I'd say if there's one message for us to think about when the next crisis comes, Australians sure as heck better not be complacent, saying, well, those kind of things cause havoc in New York and London and Europe and Greece, but they're not going to cause havoc here because we're Australians. There's lots of things to suggest that, if anything, Australia is likely to be one of the harder hit countries the next go around. In terms of the nature of the loans, Australia is now one of the most highly leveraged countries in the world. Not because of the government deficit, by the way. The government deficit on a net basis is 17% of Australia's GDP, the accumulated government debt. The accumulated debt of Australian households is 130% of GDP. And it's been driven by this need to keep up with the inflation of housing prices that in turn reinforces the expansion of credit. That mortgage debt, I suggest, is relatively fragile. I mean, when you take out a mortgage, there's obviously a house behind it. That's what the mortgage means. It means the bank has a claim on the real property. So unlike some kinds of lending, at least with mortgages, there is something real there. But the value, the ascribed value of the house, is itself a function of the confidence, or dare I say mania, that's going on in the real estate market about the fundamental value of those homes. And anything that causes that public expectation that it's normal for a tiny little worker's cottage in downtown, or not downtown, a tiny little worker's cottage in an inner suburb of Sydney to sell for $2.5 million, okay? The moment people wake up and realize that's not normal, that's friggin' insane, okay, is the moment that the floor can fall out under it. I'm going to make another analogy to children's programming here. Did anyone ever watch the old Roadrunner cartoons? You know, the Bugs Bunny cartoons, and then they'd be followed with the Roadrunner. You'd have the Roadrunner who was out running around the desert chased by the coyote, Wile E. Coyote. Wile E. Coyote. Well, what used to happen? The roadrunner would somehow zip around, make a quick turn. The coyote would follow the roadrunner, run right out off the edge of the cliff, right? But then what would happen? Strangely, thanks to the magic of animation, he would just stay there running and nothing would happen. Until what? Until he looked down. Yeah. As soon as he looked down, this is how it happened in the cartoons, he realizes there's nothing there, and that's when he goes, whoop, and then he falls. Okay, so that is a technical economic explanation of what will happen in the real estate market when people suddenly look down and say, what the heck? These things are not actually worth $2.5 million each. And that alone could cause a contraction in the underlying dynamic of this self-reinforcing asset bubble. Just as when Dutch tulip bulb buyers realized in the 17th century that it actually wasn't worth paying $50,000 for a new hybrid form of tulip, then they stopped buying and that mania collapsed as well. So I think that the next financial crisis, which will occur, is going to affect Australia directly and painfully, and I think it behooves the left to be ready for that, including an understanding of why it happened, okay, because there's going to be a whole series of proximate causes that are going to get blamed for why this happened. They're going to point to some tiny little trivial thing, which was the turning point in public consciousness, okay, instead of looking at the fundamental fragility of the whole house of cards in the first place. So if we have a little bit of progressive economic literacy about the banking system and how it works, we'll be better ready to respond to the crisis with a convincing explanation of why it occurred, why it will occur again unless we change the rules of the system, and why working people shouldn't be forced to pay for the costs of that crisis through everything from being thrown out of their homes, losing their jobs, paying higher taxes because the government bailed out a private bank with no strings attached, or any of the other ways that they'll try to make working people pay for it. In terms of the sort of more concrete policy responses, I do not think that a simple call to break up the banks, which I hear from some progressive commentators, is going to do the trick. I've often been puzzled by that response. Say what we need is a bunch of smaller profit-hungry banks instead of some big profit-hungry banks. Smaller banks are much more prone to bank failures and crises of confidence than big banks. And the fact that our banks were big was one of the things that stabilized our system clearly in both Australia and Canada in the last go-around. But obviously you can't just give humongous concentrated private profit-making corporations a free license. Recognizing that the service they provide is essential to our economy, and recognizing that we need it, and that having one or more of them collapse, or even breaking them up into smaller bits that then collapse, isn't going to serve our purposes. What we need is some kind of accountability on those private organizations in the form of obviously much stricter regulations and controls over how they create credit, what pace they create it at, who they lend it to, and what the credit is used for. Even better than trying to regulate these things, given their incredible capacity to evade regulation, would be to think about republicizing that essential economic function that I call the utility in the hands of public credit creating institutions, like public banks, cooperatives or credit unions, or even the government's capacity to run banks. Australia has banks that are publicly owned. We obviously used to have major retail banks that are publicly owned. We still have some banks that are publicly owned, providing specialist credit services in certain niches of the economy, and we could make that demand again. Another funny consequence of the GFC and the response to it has been, I think, a growing understanding that credit could be managed in different ways. And the whole phenomenon of quantitative easing, where central banks in many countries have created their own credit out of thin air and used it to try to re-inflate spending power in their respective economies, has got people thinking in dangerous ways. The quantitative easing policy itself, I think, was flawed. The central banks created this credit, just like a private bank can create credit out of thin air. The central banks created credit out of thin air, but they used it in a very targeted and biased way. They purchased financial assets from private financial institutions and investors, thinking that would cause the banks themselves to get more money flowing through the economy. You could have a very different vision of quantitative easing where you use the public credit creating mechanism to finance the construction of roads, bridges, low-cost housing, hospitals, and schools. That's just as legitimate a use of public credit as it would be to go and buy bonds and stocks from financial investors and financial institutions. And now that people understand that credit can be created without any apparent limit, there's probably a greater willingness for us to think about more progressive and radical ways that the power of public credit could be used, not just to protect ourselves against the worst effects of the next financial crisis, but actually to put people to work producing useful goods and services that we need in our economy. And that's where I'm intrigued by both the opportunity for us to think big, but also the necessity for us to think big. Because if we're not ready when the next financial crisis occurs, given what's happened over the last decade in the world, I fear that there's going to be another solution that's proposed in the form of the xenophobia and the racism and the right-wing populism that's appearing in Europe and elsewhere, which makes it all the more important that we have a positive democratic vision to take control back over the banking system. So I'll leave it at that and look forward to our questions. Thank you very much.